They are a gold miner in British Columbia right now that started producing this quarter. Obviously, in a very slow amount as they're getting ramped up. But basically, I made you guys like a model of next year. I was obviously very conservative with that model. I used very low grade. I also expected low tonnage. The reason that's important is because if we go back to my model, let me find like a wider screen so I can write. So if we remember, my assessment for 2026 was that they were going to get to 500 TPD, which means how many tons are being processed through a mill every single day. So I was expecting them to ramp up to 500, which they're still expecting. I expected an average grade of 5 grams per ton. So meaning in every single ton, you're going to have 5 grams of gold. Now, I'm still keeping that, but I'm going to explain why it's interesting to revise that and what my grounds are or my foundation are to revise that and how that impacts profits next year. Next thing I assessed was the recovery. So this means when you process, let's say, a ton of dirt at 5 grams per ton, you don't actually get all the 5 grams because there is a recovery rate. So you don't get 100% of it. I used 85%, but so far, they're actually looking at like 90 to 95%. That's just increasing how much gold they're getting at any given point. So I will revisit those numbers as well with a different assessment here. And basically, we got to a point where they were making about 18,000 ounces next year in total of gold, which was going to be bringing them plus or minus 50 million in revenue and then plus or minus 25 million in profits. The reason this is interesting is because they're ramping up, remember correctly, right? So they're looking to be producing more gold as they go and scale. So it's not like we're fixed at these rates and these numbers. It's just that first year of production once they get to that 500 ton per day. So this actually needs to be revised on the more optimistic front while still having reality. So I listened to the CEO speak yesterday. He actually mentioned that their average grade that they're expecting is over 10 grams per ton. So it's more than double. He said around 11. That's quite interesting because you're just with that higher grade, you're looking at twice the amount of gold, right? So you could actually get up to 36,000 ounces. And then if we take, let's say, a 90% recovery or a 95% recovery, then you have 5% more, even possibly up to 10% more gold. That basically implies you're nearing 40,000 ounces of gold on the less conservative, but again, very realistic. It's not like I'm embedding a huge amount of optimism here. I'm just going off what they're already saying. Why is this important, guys? Well, because the market cap right now is just about $200 million. And if next year they're looking at 25 million profit, we're priced at about 8 times forward earnings. If we're more than doubling the gold that we're going to be getting, what's actually happening is you're shifting to possibly $50 million of profit next year, which is pretty insane. And again, I was even assessing very high costs. We're expecting much lower costs. So this margin is quite reasonable, quite realistic. 50 million, they're only selling for about 4 times next year's earnings. Now, why is it important? Well, if you have a short mine life, let's say you only have 4 years of mine life in your asset, selling at a low multiple of your earnings is very reasonable because you're not going to be able to get more gold. But they're just getting started. You have a large resource, and that resource is also growing. Now, they did invert things, so they're doing a lot of the exploration after they start mining because it's not costing them a lot of money to get started. On the more optimistic side, it's an extremely attractive valuation. 4 times forward earnings before they get ramped up. Again, if we looked at their presentation on the first slide, their goal over the next 10 years is to get to 200,000 ounces a year. I'm not saying they're going to get there. I'm not saying it's going to be a smooth way to get there, but whether they get there or not on the current valuation and the current price of the company is pretty much, in my perspective, irrelevant because of the numbers that we're looking at and the unit economics to be able to mine this gold in a tier 1 jurisdiction. They have 2 other possible mines that they would like to bring into production on the same land package, but in different regions. So there's a huge amount in the pipeline. So I wanted to revise this because ultimately I wasn't extremely conservative on a Tuesday call explaining my valuation thesis. And I thought I would still bring in a more positive lens to what things could look like at the end of next year, which is significant earnings compared to the current company value. So I'm going to jump off of Talisker because I did spend quite a bit of time with them on Tuesday. And I'm going to go into a different type of company. And this is basically, it's called Hycroft. It's Nevada. Again, a tier 1 jurisdiction. They are just expanding their resource. So this is more the thesis of like, well, if I'm going to buy gold or silver, I rather buy gold or silver that's in the ground because it's so cheap. They have a lot a lot of it. As you guys can see, you're looking at huge amount of silver, very low grades. And this is where the issue arises. And this is why their valuation is still very low. I've talked to you guys probably a week or two ago about ultimately the grade. So the amount of gold or silver that needs to be in the ground for it to be economically viable to sustain your project, to actually get profits. They're pretty much on the fence when it comes to gold and silver. They're actually below in most cases. So meaning throughout the last 10 years, it's actually not profitable to mine gold at these grades unless you have an open pit with low costs in certain jurisdictions. So you might be thinking like, okay, Josh, I have a huge resource, but why the hell are you looking at them if their grade is absolute dog shit? The reason I am is because the worst companies become the best investments when gold and silver go up rapidly. Because the moment it becomes economical to mine this, you're paying so little for the company right now. When it gets economical to actually mine these resources, you can see absolutely insane amounts of value. So it's really just a question of like, do we believe over the next 10, 20 years, there's going to be a path to production that is economically viable, that is able to pass the checks, the preliminary economic assessment, the pre-feasibility study. All that's just fancy language to say the different steps that are needed in order to get permitting, in order to get your funding, and to get ramped up. Another reason I like them very much, talk to you guys about looking at who owns the companies. So for them, this is what I really like. Number one, you have very high insider institutional ownership. And again, very high, not that much, but I'm factoring in this guy right here. This is pretty much one of the most recognized resource investors in Canada. For those of you who've never heard the name and who are interested in the sector, there's a lot of content out there, whether it's presentations, conferences. He talks about his investments quite substantially. And he's been one of the biggest funders of this company. He's bought huge amounts of shares this year as the prices have gone up. Because yes, even this company has gone up in stock price this year. Ultimately, this means that you have pretty much 50% of the company owned in what I would consider to be long-term. People who are not investing for tomorrow, for next week, for next year. Eric Sprott has had several companies down 80, 90% from his initial positions, where 10, 15 years later, he ends up being up 1,000, 5,000%. So he really invests for the long term. You have good holdings, good ownership here. Massive optionality for the gold and silver prices. The way I look at an investment like this, just to kind of give you my thesis, is I'm basically land banking. Some people you know or yourselves invest in land and just say like, I'm going to sit on this land for 20 years. It's going to keep value. Basically sitting on land that has a bunch of gold and silver, that gold and silver is not going anywhere. And if ever it is brought into production, the implications of that means tremendous shareholder value. I don't want to spend too much time on this one because like I said, it's kind of a weird one, but I think tier one jurisdiction like that, ownership and cap table like that a lot. The price, so the market capitalization divided by all the resources, the gold and silver that's in the ground, like that as well. So it checks most of my boxes besides one of the most important ones, which is a path to production. They're doing those things because ultimately they have a very sharp investment base. They're looking to do their preliminary economic assessment at the end of this year. Now, based on those results, shareholders are either going to be very happy or quite disappointed. I'm not that optimistic. Now, the thing that's going for us is the fact that gold's at an all-time high, significantly over anything we've seen before, and silver's inching up towards its all-time high. So depending on what resource price they use, because you're not allowed to just use the highest price, right? Typically you use like the trailing price over the last 3 years or over the last 2 years. You have to be conservative when making this economic assessment. But depending on what resource price they use, we might see a financially viable path to production. And that would be very interesting because of the size of the resource. I would say end of this year or early next year is an interesting time to be looking at this company and seeing really how it evolves. This is one, I'm not even sure if my order got filled. I added to Golconda gold because it pulled back quite a bit today on the downturn of the metals prices. They are producing. Right now they're selling at 26 times their earnings over the last 12 months. Fairly small market cap for a miner, 130 million. Now, if we go in their financials, right? If we're looking at a price to earnings ratio that's based on the last year, we want to know, is that actually reflective of the next year? Well, number one, gold prices were significantly lower then. So already we know it's not reflective of next year. But then number two, we look at quarter over quarter, we went from negative income a year ago and pretty much the same quarter that just finished yesterday to 600,000 in income to 1.5 million and then to 2.3 million in the last quarter. So we're seeing income growth. Now, the second thing we're looking at, and this is why I like them quite a bit. So this is their their producing asset. It is in South Africa. Yes, geopolitical risk is there, but ultimately I have mines that are in much worse geopolitical regions. Now, one of the things to really quickly notice is the mine life. Why? Because if we're using a price to earnings ratio, we want to actually know that the earnings are there for the long haul. And if I tell you we're selling at 10 times earnings, but our mine is going to be absolutely empty in 2 years, that doesn't help me. I'm like, okay, well then what else are they going to build? Because there's no more earnings in 2 years. So for them, there's an extremely long mine life already. They're implying about 20 years plus a massive resource. I typically love over 2 million ounces, like over 1 million ounces. I'm already quite good, but this is very, very high. Something we're going to notice as well as if we look at their production, this is where it gets quite interesting. This has been their production up to date. Now notice we saw 2 million ounces on their reserves, and now they're saying they've been doing 12,000 ounces a year. So if you do the math real quick, you'll notice that's not 20 years of mine life. That's why they had a plus plus next to it. At that rate, that's like 100 years plus 150 years. Massive mine life at that rate. So what are they actually planning to do? They're planning to grow the production at that asset in the coming years in order to get to, yes, a shorter mine life, but to have a lot more earnings, especially with the higher metals prices. So in the second half of this year, they're trying to do 15,000 ounces a month. What does that equate to? That is 18,000 a year. So already that's 50% more what they've been producing up to date, right? So the earnings we've been looking at, not only are these earnings based on lower gold prices, but on top of that, we're wrapping up to higher production with higher gold prices. So you're starting to see like a dual positive effect on their coming earnings, which is really interesting. And then you can look at 2026, they're trying to get to 20,000, 2027, 25,000, and then on from there. If we take just this quarter, which has actually what I would say quite bad production and not reflective of the current gold prices, this on an annual basis is about 9 million a year. So at $9 million a year at $133 million market cap, you're basically selling at like a bit less, but call it 15 times earnings. Now, the issue is they're increasing production by 50% and the cost of gold went up by around 15% as well. So you're basically going to get to a point where this coming quarter is probably going to see around 3 million in earnings. The next one at these gold prices would be like 3.5 million. And that's where things get interesting because you start quickly really reducing your price to earnings ratio on a future 12-month basis. Just with that asset, especially because it has a really long mine life, I really love it. And then obviously the coming years, there's going to be more production. So again, larger and larger and larger earnings. But what I really like about this asset is the second part of what they got going. This is the asset that I'm really excited about. First thing to take into account, there's a short mine life to it. They actually bought it. It was a past producing mine. But what I do like about it is that it's in the US and it's past producer. So we know that there's a resource, there's already infrastructure there, and they're looking to bring that back into production next year. So again, even more growing their production profile. Why is this important? They're going from being valued as a higher risk jurisdiction to now having a dual asset with lower risk. So I really, really, really like this. Doesn't have crazy costs. We're looking at, as we can see here, all these figures are in US dollars, but they're expecting around this. I always add like a 20% buffer just because. So I'm looking at like a $2,000 US all-in sustaining cost, $3,800 gold. So like even add 50% to that and you're still extremely comfortable. What might be the most important thing here, similar to Silver Storm, which is a silver company I've shared a lot on my stories, they have a plan with that asset, which is quite interesting. Yeah, so this is the restart timeline. So middle of next year, they're going to get started with it. And then beginning of 2027, it should be fully producing. But they're not looking to keep it in the company. Why? It's actually what I would consider probably one of the most strategic theses. And what I like is that they're very clear about it. Remember when I told you guys last call, which is we want a clear path. The clearer the path that management is having, the more conviction I have, because it's not about like, oh, we're going to figure it out as we go. It's like, this is what we're doing and this is why. And it's a lot easier to get on board and to be able to measure it against the baseline. If a management team isn't telling you what the goal is and they don't hit the goal, then you actually don't have a point of reference to be like, oh, well, this is not a company that I like. It's not performing the way it should. But when you have clear goals like this with clear timelines, it becomes a lot more clear and a lot more of a better way to hold management accountable and then to really see how they're thinking strategically. A spin out is what First Majestic did with Silver Storm, which is a company I really like. Basically what they're saying is, okay, well, we're going to have two assets, but then a lot of investors don't necessarily like us because we're in South Africa. So if we just add a really high quality jurisdiction asset in here, we might still get penalized on the valuation because half of our company is in a riskier jurisdiction. So what we rather do in order for the public markets to give this asset its full valuation and possibly even a premium is to have an independent asset that is producing in the US. US investors love that. The equities markets there really love local investments in the mining sector. So they're looking to spin it out to create shareholder value as much as possible. So the valuation can actually expand to its full possible size versus being like dragged down by the fact that they're also in South Africa. So I think that's a really strong plan. It also allows them to focus more boots on the ground in South Africa. These are two completely different jurisdictions. But yeah, so really what they want to do, they want to bring it back into production, want to have 1 or 2 quarters of full production and then spin it out. So even at the spin out, they want the full production to be there first. That way you can spin it out for the highest value. The way First Majestic spun out Silver Storm is they retained around 25% ownership and then they sold it to another company. So these guys might do the same thing. They might retain more, they might retain less. In some cases, they might spin it out and even give us direct shares almost like as a dividend of that spin out company. There's all kinds of ways this can happen, but this is to me a very solid path. And then, like I said, my first checkbox is, well, number 1, profitability. Number 2 is that they have a massive asset with additional space that they have not yet explored whatsoever. Quite interesting grades, right? Remember we said like around 0.5 to 0.75 grams per ton is where things start being economical. You're looking at like 2.79 grams per ton. And again, without being mean or hurtful, it is less expensive to do business in South Africa than it is in Canada, right? It's not like you're dealing with a $15 minimum wage with employment benefits and all this. So you're dealing with companies that can have higher margins, lower all-in sustaining costs for their resources. And this is really a growth story. This is about ramping up. Like, okay, we're at 12,000 ounces a year now. What do our numbers look like when we get to 20? What about 25? What about 30? And this is kind of the compound effect that I like in Step Gold, that Mongolian miner that I keep talking about, especially some of you are probably tired of hearing about it, is because you have, let's say, a doubling of production over 2 years while also having a doubling of the gold price. So what that means is your earnings can actually quadruple. And then you're still being valued on the earnings of a year ago at even lower gold prices. So it's like a massive distortion between how the market is pricing the earnings and how we can project it into the future. Again, massively small market cap. Don't expect this to be a consistent grind up. Has been so far. I'm actually quite sad that I didn't find this company sooner. It was trading at like 5-10 cents early 2024. It's at $1.80. So yes, it's gone to the freaking stratosphere. But again, we have to take into account that this time last year, they weren't profitable. And we went from non-profitable to high and growing profits, massive mine life, and growing production, right? This is a perfect example of finding value in the high cost producers that aren't able to turn a profit. It's obviously the most risky times to be buying, but this probably exemplifies it the best. So this is the US asset based on the mine life that it has currently, not on any further exploration. And it's sensitive to different gold prices. All right, so we're looking at, okay, $2,500 gold. Our assessment is your net asset value based on those 6 years of mine life would be $1.48 per share. 3,500, sorry, $2.42. And we're basically at like 3,800 right now. The non-producive spin-off asset possibly being worth their entire current market cap. Their stock price right now is $1.80 per share. And this is not their company right now. Like this is just the side project that's going to be spun out. That's what I really, really like. At this point, the main risk is geopolitical in South Africa. In full transparency, I have a tiny position in this company, primarily, I would say, because I just expect volatility to the downside, and I have a hard time conceiving that it's not going to happen. But I see a huge amount of value. Do I smack myself in the face for not discovering this company sooner? Absolutely. But that's kind of where I'm at with an asset like this. Okay, I'll just preview this company. They've been in a very weird situation because they are probably the cheapest producer there is right now, or the cheapest one that I've seen that is currently profitable, right? Very little. Right? You're dealing in a position where, like, if things go wrong very quickly, you're at a loss. They have a $27 million market cap. The CEO explained that right now, the higher gold and silver prices, they're looking at between $1 million to $1.5 million of free cash flow every single month. It means in a quarter, that's like 3 to 4.5 million. In a year, that's like 12 to 15 million. They can use that free cash flow in all kinds of different places. They raised money this year. They don't really have any debt. So now they actually have loaded coffers to be able to go start exploring, go drilling in different projects in different zones. My biggest red flag for them, obviously, besides the fact that, like, they're a tiny company, is this investor presentation. And it's going to sound stupid. It sounds like I'm just being picky, but ultimately a company needs to be able to demonstrate its value and needs to be able to please serious institutional investors to be able to jump in. One of the things the CEO pointed out in the discussion that I was listening to is that because they never needed to raise money and they don't have debt, they're in a very odd spot because most early stage producers need to raise money and have debt to be able to get their mine, get them going. because they didn't need to do that, they've never really had to attract any of the attention in the public markets. They explained that a shift was needed in the company right now, so they would basically be more attractive to more serious investors. He's also one of the biggest shareholders himself. He's been adding with his own money on their free market. They have a 10-year mine life, but they have money now, they're profitable, and they can explore and have 10 years to make up a resource somewhere else. Again, very highly levered to the gold and silver prices. That is great on the way up. That's also disgusting on the way down. Keep that in mind.